All right, let's reset the room for a second. I know for the past few videos we've been deep in the weeds, banks, balance sheets, paper markets, derivatives, stacked on derivatives, the usual financial magic show. We talked about JP Morgan flipping long. We talked about European banks wobbling. We talked about price suppression, synthetic supply, and how silver has spent decades being pushed around by people trading contracts they never intended to settle. Now forget all of that. Forget the Fed. Forget the trading desks in New York. Forget the COMEX floor theatrics. Because while everyone was watching the magicians distract the crowd, something much bigger walked through the side door. Something that doesn't care about spot price, doesn't care about charts, and definitely doesn't care about your favorite technical indicator. This new player only cares about one thing: survival. I'm talking about industrial giants, big tech, manufacturing empires from the East. I'm talking about companies like Samsung. For nearly 40 years, the price of silver was set by men in suits shuffling paper in London and New York. They traded promises. They traded leverage. They traded air. But that era is ending. Today, the price of silver is increasingly being dictated by people in lab coats in Seoul, engineers in Tokyo, and factory planners in Shenzhen. The center of gravity has shifted from financial speculation to industrial necessity. And here, it's the part that should make you sit up a little straighter. These buyers are not hedging inflation, and they're not chasing returns. They're buying silver because without it, their companies literally stop functioning. Let's talk about something that hasn't been making headlines. Reports coming out of South Korea suggest that Samsung SDI, the battery and advanced electronics arm of Samsung, has begun aggressively stockpiling critical metals. Not just lithium, not just cobalt, physical silver, and not token amounts either, strategic volumes. Why now? Because the global supply chain model snapped. Just in time, inventory didn't just fail. It was publicly executed between 2020 and 2022. In 2026, it has been replaced by just in case. Corporations finally accepted that depending on fragile global flows for mission-critical materials is corporate suicide. Samsung, Apple, Tesla, they all came to the same conclusion. Silver is the bottleneck of the 21st century. No silver, no phones. No silver, no EVs. No silver, no grid infrastructure. No silver, no advanced weapon systems. This isn't optional. This is existential. And that changes everything. When a hedge fund buys silver, they have a sell button. If price drops, they bail. If price spikes, they take profits. Weak hands. But when Samsung buys silver to feed a solid-state battery line or next-gen semiconductor production, that metal never comes back. It's consumed. It's bonded, welded, etched, vapor deposited. It's gone forever. Industrial buyers are the ultimate diamond hands. We used to worry about JP Morgan suppressing the market. But here's the truth. JP Morgan is rational. They want profit. Samsung is not rational in that sense. Samsung is existential. If silver hits $50, a bank might sell. If silver hits $50, Samsung buys more. At $100, they buy more. At $500, they still buy, because the alternative is shutting down a $200 billion manufacturing ecosystem. That's inelastic demand. Price becomes irrelevant when the input is non-negotiable. Silver isn't just undervalued, it's misunderstood. The tech giants saw the same data everyone else ignored: declining mine grades, falling production, and a structural deficit that isn't cyclical. When they panicked, they didn't run to coin shops. They sent lawyers, geologists, and engineers directly to the mines. They bypassed the COMEX. They bypassed the LBMA. They signed long-term offtake agreements, 10 years, 100% of production, massive upfront capital. Don't ship to London, they say. Ship it straight to us. This is the vault vacuum. This is why exchange inventories keep draining even when price looks sleepy. The metal is being intercepted upstream. The COMEX is just the reservoir. Samsung is building dams above it. We are watching the quiet privatization of the global silver supply. Elon Musk hinted at this years ago with nickel. Now it's happening with silver, and the scale is far larger. The green energy transition everyone keeps talking about, that's not a lithium story. It's a silver story. You cannot electrify the world without it. Think about Samsung's footprint: ships, chips, screens, batteries, appliances, infrastructure. Every one of those requires silver. It's the most conductive metal known, the most reflective, naturally antibacterial, and critically irreplaceable at high performance levels. Scientists have spent decades trying to replace silver with copper or aluminum in advanced electronics. It works on paper. It fails in reality. Losses rise, heat builds, reliability drops. Silver isn't expensive because it's precious. It's expensive because it works. It's the Goldilocks metal, and the Goldilocks metal is running out. The silver deficit in 2024 exceeded 200 million ounces. It grew again in 2025. Now, heading into 2026, with new industrial mandates kicking in, the projected shortfall could rival the entire annual production of Peru and Australia combined. This is why banks flipped long. Not because they suddenly fell in love with silver, but because they saw the purchase orders. They saw the industrial flows. You cannot sustainably short a market where the largest buyer has unlimited capital and zero price sensitivity. This isn't a famine of food, it's a famine of conductivity. And in a digital civilization, conductivity is life. Control silver and you control energy flow, data flow, and manufacturing capacity. Samsung knows it. China knows it. China has already restricted silver exports. They're hoarding domestic production. Meanwhile, the West sells silver eagles to collectors like souvenirs, while the East stockpiles industrial bars to build empires. We trade coins, they trade futures, real ones. So where does that leave investors? It leaves us holding the one thing the giants ultimately need. For now, they're draining the mines directly, but mines aren't infinite. Eventually, they come to the open market. They come to ETFs. They come to private holders. Picture the headline no one wants to imagine. Production delays announced due to silver shortages. One sentence. The price doesn't creep up, it gaps. Violently, and we're not done yet. Because within tech, there's one sector consuming silver faster than anything else. Solar. Photovoltaics. The solar singularity. For years, analysts told us not to worry. Solar would thrift silver. Panels would get more efficient and use less metal. And for a while that was true, but physics always collects its debt. The old PERC technology is being phased out. The future belongs to TOPCon and HJT, heterojunction cells. Here's the catch. These new cells use 50 to 80% more silver per panel. Thicker paste, dual side contacts, higher conductivity demands. We are no longer reducing silver load, we are increasing it. Now layer that onto 2026, legally binding green energy mandates across Europe, China, and parts of the US, trillions in subsidies. Solar farms in deserts, on rooftops floating offshore, governments printing money to install silver into glass at industrial scale. This isn't a theory, it's math. And math doesn't care about narratives. The industrial famine has arrived. The table is set, and the biggest players in the world aren't asking what silver costs. They were asking how much they can get before someone else does. Let's put some hard numbers on the table, because this is where the story stops being dramatic and starts being uncomfortable. In 2024, the global solar industry consumed about 190 million ounces of silver. That was already a record year. Roughly 1/5 of the entire world's silver supply went into one application, turning sunlight into electricity. At the time, people shrugged and said, it's manageable. Fast forward to now, and those projections look almost quaint. By 2026, with the full transition to TOPCon and HJT solar cells and the sheer scale of new gigawatts being installed, estimates put solar silver demand somewhere between 300 and 350 million ounces per year. Let that sink in for a second. 350 million ounces. Nearly 40% of all the silver mined globally consumed by a single industry just for solar panels. One sector, almost half the supply. Now ask the obvious question. What's left? What's left for jewelry? For medical uses? For electronics outside of solar? For coins, bars, ETFs, and reserves? The uncomfortable answer is not much. This stops being a growth story and becomes a zero-sum game. Someone gets the silver and someone else doesn't. Inside the solar industry, this reality isn't theoretical. It's already panic-inducing. I talk to people who work close to these supply chains, and the mood inside the boardrooms of Chinese solar giants like Jinko Solar and Longyi is not optimism. It's fear, real fear. They are terrified of running out of silver paste. If that happens, production lines stop. If production lines stop, government delivery targets are missed. If those contracts are breached, financing dries up. And when that happens, even a $1 trillion green mandate doesn't save you from bankruptcy court. So these companies do the only rational thing they can do. They buy at any price. If silver is $30, they buy. If silver is $80, they buy. If silver is $150, they buy. Because silver only represents roughly 10 to 15% of the total cost of a solar panel. If silver doubles, the panel gets maybe 10% more expensive. Painful, yes. Fatal, no. That cost can be passed on, subsidized, or absorbed. But a missing metal? That's not a rounding error. That's an existential threat. This behavior creates something the paper traders never had to deal with, a concrete price floor. Solar demand isn't emotional. It isn't speculative. It doesn't care about RSI or Fibonacci retracements. It's a vacuum cleaner that runs 24 hours a day, 7 days a week, competing with every other major consumer of silver on the planet. And it's not competing in isolation. It's competing with Samsung's battery divisions, with advanced electronics manufacturers, and with investment demand that hasn't even fully woken up yet. Now let's talk about the role of governments, because this is where the irony gets thick. The US government and the European Union have passed binding legislation mandating a massive transition to renewable energy. They've essentially legislated a silver squeeze. They wrote the laws before checking the geology. They printed the checks before checking the vaults. They mandated the consumption of a metal they do not control and do not meaningfully stockpile. This is the punchline no one wants to acknowledge. The same governments that tolerated 40 years of price suppression in precious metals are now forcing the market to do the exact opposite. If they want green energy at scale, they need high silver prices to incentivize exploration, development, and mining. If they suppress the price, supply collapses and the green transition fails. They've boxed themselves in. So now they have to choose. Protect the old financial system or feed the new energy system. And it looks increasingly like they've chosen the latter. Conveniently, the banks have noticed and switched sides just in time to profit from it. There's another critical detail here that most people miss. Solar demand is consumptive. When you buy a silver coin, that silver still exists. It can be melted down, reused, resold. When silver is printed onto a solar panel, it's effectively destroyed from a market perspective. It's fused to silicon and glass and bolted to a roof for 25 years. Recycling silver from solar panels is technically possible, but economically unattractive. It's expensive, energy intensive, and inefficient. Most panels will end up buried or dismantled with minimal recovery. So we're taking 300 to 350 million ounces a year, the combined production of major mining nations, and we are burying it. This isn't recycling, it's depletion. And the growth curve isn't linear. Solar installations aren't creeping upward, they're going vertical. India is just getting started. Africa is just getting started. Southeast Asia is accelerating. Every human being on Earth wants electricity, and silver is the conduit that makes modern electricity efficient. This isn't market speculation. This is government-mandated hunger. Solar manufacturers have now started bypassing traditional silver paste suppliers and attempting to secure raw silver bars directly. They're behaving less like manufacturers and more like central banks. They're stockpiling. When you look at a silver price chart, stop staring at resistance levels from 1980. Look at the global solar installation chart instead. They tell the same story, just on different axes. The price of silver has been artificially delayed by paper markets, but the physical gravity of hundreds of millions of ounces of annual demand doesn't disappear. It accumulates, and eventually, gravity wins. This is why the banker flip happened. JP Morgan didn't wake up one morning and decide silver was shiny again. They ran the numbers, they counted panels, they modeled the supply chain. They know the math does not work at $30 silver. It barely works at $100. Higher prices aren't bullish fantasies, they're requirements. The solar singularity is a black hole, and it's pulling silver in relentlessly. Now add another force to this equation, and this is where things get truly uncomfortable. Solid-state batteries. For years, electric vehicles relied on conventional lithium-ion batteries. Silver was present, but marginal, maybe 20 to 30 grams per vehicle for electronics, switches, and connections. Important, but not transformative. Solid-state batteries change that completely. This is the holy grail of EV technology. Faster charging, longer range, no thermal runaway. Samsung has announced pilot lines in 2026 with mass production targeted for 2027. Toyota is doing the same. This isn't science fiction anymore. Here's the detail that doesn't make it into press releases. One of the most effective anode materials for solid-state batteries is a silver-carbon composite. To stabilize the chemistry and enable ultra-fast charging, manufacturers are using layers of silver nanoparticles. How much silver? Early estimates range from 50 to 100 grams per vehicle. Let's be conservative and say 50 grams. Multiply that by 20 million EVs per year. That's 1 billion grams of silver, or roughly 32 million ounces, just for the batteries. Add the silver already used in vehicle electronics, and you're approaching 100 million ounces annually for the auto sector alone. And that's before adoption accelerates or designs increase silver loading for performance. Now step back and look at the picture forming. Solar on one side, EVs on the other. Two industries that together could consume the entirety of global mine supply. This is an industrial pincer movement. In the middle sit jewelry, legacy electronics, and investment demand, all competing for what's left. Samsung understands this better than almost anyone because they're building the batteries themselves. They know the chemistry. They know the limits. They know that without silver, the solid-state revolution collapses before it begins. That's why they're buying mines. That's why they're signing offtake agreements. That's why they're panic buying. Which brings us back to the vault vacuum. In the old system, silver flowed predictably. Mines produced doré bars. Swiss refineries upgraded them. Metal moved into London and COMEX vaults, where it became visible, reportable, and tradable. That chain is breaking. Now, Samsung walks straight into Peru and says, "We'll build a refinery next to your mine. We'll take the doré, refine it ourselves, and fly it directly to our factories." The silver never touches the open market. It never appears in exchange inventories. It never shows up in public reports. On paper, 800 million ounces are produced. In reality, only half of that is visible. The rest disappears into private stockpiles, and that creates the most dangerous illusion of all, the illusion of abundance. For the shorts, it's comforting. For everyone else, it's a trap. At first glance, the reports look reassuring. Mining output is published, supply tables are updated, and analysts confidently say, "Relax, there's plenty of silver out there." On paper, that's true. On paper. But then someone actually tries to take delivery, and suddenly the story changes. The vault doors open, and there's nothing behind them. The supply exists, but it's not free. It's encumbered. It's already spoken for. That silver isn't sitting idle waiting for traders. It's owned. It's locked up by Samsung, by Apple, by Raytheon, by industrial giants who signed contracts years in advance. This is the vault vacuum in action, and it explains something that's been quietly flashing red: lease rates. If you want to lease silver today, you'll pay a premium that makes your eyes water. Why? Because there's no loose metal. Almost all of it is tied up in long-term industrial offtake agreements. The derivatives market we talked about before is built on the assumption of a healthy public float. But the public float is shrinking every single day. Liquidity is evaporating. And when you combine shrinking liquidity with rising, non-negotiable demand, you don't get orderly price discovery. You get gaps. You get violent moves. You get a market where silver can jump $5 in seconds simply because there are no sellers. Samsung isn't cornering the market to squeeze profits. They're cornering it to survive. That distinction matters. The Hunt brothers attempted an offensive corner in 1980. They wanted to break the banks. Eventually, they had to sell. Samsung is executing a defensive corner. They don't intend to sell, ever. They intend to consume the metal. That makes this far more dangerous. What we're witnessing is the definancialization of silver. It's transitioning from a monetary metal traded by banks into a strategic resource hoarded by empires. Think uranium. You don't day trade uranium, you don't impulse buy it. It's controlled, strategic, and critical. Silver is moving into that category, whether the market is ready for it or not. And this shift leaves the paper market naked. COMEX contracts are claims on metal that is quietly disappearing into private industrial vaults. The ratio of paper claims to real deliverable ounces is exploding. It used to be 100 to 1. Soon it could be 300 to 1, 500 to 1, or worse. When the music stops and someone demands a delivery, they'll discover the uncomfortable truth. The industrial silver is gone. The strategic silver is gone. What's left is the silver in private hands, the coin in your pocket, the bar in your safe. That makes individual holders the market makers of last resort. And eventually the phone rings. Eventually, the same companies that bypassed the market will come back to it, offering massive premiums over spot, not because they want to, but because they have to. Picture a "we buy silver" ad that pays 50% above spot, not to flip inventory, but to keep factories running. Solid-state batteries are the nail in the coffin for cheap silver. They turn silver from a precious metal into a battery metal. And we've seen this movie before. Look at lithium. Look at cobalt. When a metal becomes essential to energy storage, the price doesn't politely trend upward. It reprices violently. We've covered demand, and it's monstrous. Solar, batteries, tech giants, a three-headed dragon chewing through everything in sight. Now, let's talk about the other side of the equation, supply. Can miners ride in and save the day? Short answer, no. Long answer, absolutely not. Welcome to the supply cliff. For over a decade, silver prices were suppressed so aggressively that the mining industry went into survival mode. Exploration budgets were slashed, development projects were shelved, geologists were laid off, mines were mothballed. And here is the inconvenient truth. You cannot turn a mine back on like a light switch. From discovery to first pour takes roughly 10 years. 10. If we found a world-class deposit today, it wouldn't produce meaningful ounces until the mid-2030s. But Samsung needs silver now. Solar needs silver now. The market doesn't care about future promises. Geology isn't helping either. Ore grades are collapsing. 20 years ago, it wasn't unusual to find deposits yielding 15 or 20 ounces per ton. Today, many operations are digging through rock that contains 4 or 5 ounces per ton. That means more dirt moved, more energy burned, more diesel consumed, more water used, all for fewer ounces. Inflation hits miners harder than almost anyone. The all-in sustaining cost of silver production is climbing toward $20, $25, even $30 per ounce in some regions. At a $30 spot price, many miners aren't thriving, they're barely surviving. There's no excess capital for exploration, no incentive to expand. This is the long-term consequence of price suppression. By keeping prices artificially low, the system destroyed its own supply pipeline. The seed corn was eaten, and now the famine has arrived. And remember this critical point. Roughly 70% of silver production is a byproduct. It comes out of copper, lead, and zinc mines. Silver isn't the primary target. It's a bonus, That means silver supply is largely inelastic. Even if silver goes to $100, a copper miner doesn't suddenly produce more copper just to get the silver. They care about copper prices, not silver. So supply doesn't respond to price. Demand, meanwhile, is vertical. This is economics 101. When demand explodes and supply cannot respond, price must rise until demand is destroyed. But here's the twist. We've already established that industrial demand is inelastic. Samsung doesn't stop buying at $50. Solar doesn't stop at $100. So what gets destroyed? Monetary demand. Small investors get priced out. Jewelry buyers get priced out. Retail availability disappears. Silver becomes unobtainable. You don't see out-of-stock signs anymore because they never come down. Premiums detach completely from spot. The screen might say $100, but the physical price becomes call for quote. This is where industrial famine collides with investment panic. As prices rise, investors wake up. Momentum attracts attention. People want exposure. But when they arrive, the cupboards are already bare. Industry bought first. That collision is what creates the super spike. Not speculation, but competition between entities that cannot walk away. The banks understand this. They have the data, satellite imagery, geological surveys, production models. They know the mines are tapped out. That's why they stopped shorting. You don't short a famine. You hoard supplies. And that's exactly what JP Morgan has been doing. Now layer in geopolitics. Mexico, the world's largest silver producer, is becoming increasingly hostile to foreign miners. Peru is unstable. Tax regimes are shifting. Nationalization rhetoric is getting louder. The supply chain is fragile. One major strike in Mexico or one blockade in Peru and the world instantly loses 20% of its silver supply. In a balanced market, that's disruptive. In a tight market, it's catastrophic. Samsung sees this. That's why they're buying mines outright. They want vertical integration. They want control from the dirt to the device. So what's the end game? The end game is a price revaluation that shocks people who haven't been paying attention. This isn't a bubble. A bubble is when price exceeds value. This is the opposite. Silver has been undervalued for decades, pinned down by paper leverage. The industrial famine is the bolt cutter snapping that wire. When the spring releases, it doesn't stop neatly at $50. It overshoots. History tells us that clearly. Palladium ran from $500 to $3,000 when industry ran out. Rhodium went to $29,000. Silver isn't special in that sense. It's just late. This is the warning shot. The window to acquire physical silver isn't closing because of price. It's closing because of availability. Soon you won't be competing with other investors. You'll be competing with Samsung, with government mandates, with military procurement, and you will lose that bidding war. They have deeper pockets. They have legal mandates. They have leverage. But right now, in this narrow moment of history, you can still buy an ounce of the same strategic metal that powers satellites, missiles, and next-generation batteries for the price of a forgettable dinner. That asymmetry doesn't last. The famine is here. The whales are feeding, the vaults are draining. Samsung already made its move. The only real question left is whether you made yours.